I'm Jared Pratt, CEO of Granite Peak Associates.
I'm Heather Piazza, Tax Manager at Granite Peak.
We're gonna have to timestamp this video because the corporate market's changing every day. Multiples are changing, the deal structure's changing. So Heather, what are we seeing currently for exit multiples for a corporate consolidator buying a veterinary practice?
Right now, the typical corporate multiple would be about 9 to 11 right now.
What's a 9 to 11 mean?
If you take your net income, let's start there. Take your net income, we have a couple standard adjustments. We add back interest, taxes, depreciation, and amortization. That gets you to your typical EBITDA that you would reference. From there, we take any discretionary or one-time expenses and we get to an adjusted EBITDA. You multiply that adjusted EBITDA by that 9 to 11 multiple, and that's how we arrive at that company value that a corporate buyer will come in and look to purchase your company at.
So you're telling me if I'm looking at my P&L, not to focus on the bottom line, there's an extra step that needs to take to make sure I get to the right EBITDA number.
Exactly. There are a lot of adjustments that we can do to increase that bottom line number. We want to add back any non-cash expenses, and we want to add back any one-time or discretionary costs to get to that adjusted EBITDA number.
Why don't you give us an example of like a one-time cost that you'd see within a calendar year?
Yeah, some typical ones that you would see in a calendar year. You have your obvious ones, so we have charitable contributions. If a corporate buyer was coming in and buying your practice, they wouldn't be the same charitable way as you would be.
Sure.
Another example would be travel and entertainment. If you're traveling or taking your clients out or buying food for your current staff, those are all adjustments that we can add back and increase the value of your company.
I think the essence here is what's important is, regardless if your sale is imminent tomorrow or you're going 5 years from now, getting a baseline understanding of what that EBITDA is that Heather just talked on. What is the market bearing? Is it a 9x multiple? Is it an 11x multiple? Because that's touched to frame up, how are you going to grow your practice? Are you going to keep it more lifestyle practice, or is there room to grow and add another doctor or two doctors, make an expansion within your practice, and keeping that end in sight, because that's going to be super valuable when you come to us and say, hey, exit is on the horizon. What's my clinic worth?